What is this rotation that you see already starting to unfold?
So last year you had growth dominating value by the biggest margin since 1979. We think that's got to end because it's at valuation extremes, and we think the things that pushed growth last year are slowing down, and the things that hurt value are exactly reversing. So we're starting to see it since the fourth quarter. Value's been outpacing growth. Growth has slowed down a lot, and this year you've started to see financials start to do a lot better. Financials have a disproportionate exposure in the value indexes. We think that they're poised to have to lead the market this year. And while we think technology can do fine, we think it's going to slow down and participate with the market rather than lead the market.
So let's just talk a second about the Russell 2000. We've mentioned it on the show quite a bit this year, at least, and it's the best performer so far this year. What do you attribute that to, and why are so many people saying it's all about large cap tech when small caps are the outperformers?
So small caps had a very bad 9 months last year, and as people started to look toward the economy opening up, toward the COVID vaccine and a better 2021 economy, they started to look at things that were most leveraged to the upside, and smaller cap stocks are most leveraged to the U.S. economy. So they're starting to do better. They're catching up. We think they're selling at reasonable valuations right now, but again, we think that there are parts of the Russell 2000 that are expensive, primarily the hot technology stocks, and we think the duller value stocks are still selling at a pretty reasonable price. So we're looking for a pretty big rotation to boring. The previous spot was just about IPOs on really hot technology type companies. We think that's an area that's very risky. The stuff that we think is a lot more interesting from a stock market perspective going forward is the dull, the slow and steady. So we like financials, we like healthcare. Utilities have been horrible this year. We think they're poised to do much better. You get a very safe 4.5% yield, which we think is going to be a good thing this year, especially since money markets are zero. We think telecom will start to do better. Industrials will do better. So there are lots of places to make money, but the watchword for this year is going to be conservative. We also think dividend stocks, which were miserable in 2020, are going to be a very good place to be in 2021.
All right, David, you're bringing plenty of excitement. So let's focus on those dull sectors just for a moment. You mentioned utilities, and also in your note that you sent us, you mentioned consumer staples. Both of those are often tied to that work from home, stay at home play. Obviously, if we're all at home, we're using more power and we're eating more at home. Where do you see the upside there for those? Are there specific stocks that you see that gaining?
Both specific stocks and the group. So we think that the stocks have done so poorly of late. Even though they had a great run in the first quarter and second quarter of last year, they've really lagged for the last 6 months. So we think they're going to start to play catch up. So a company like Coca-Cola is a reopening play. Half of their business comes from stadiums, from restaurants. So we think you can get a very good yield in Coca-Cola, and it's a reopening play. In terms of utilities, they're doing well, whether the economy's open, whether the economy's closed. They're just making nice earnings, and they're paying that out to investors. Yet nobody has really cared. Utilities did poorly last year and started this year out poorly. So we think that they're at about 15 times earnings, very good yield, dull, but we think dull is going to be good, especially if some of the more speculative sectors start to slow down. We think some of the stay-at-home plays like the Zooms of the world, all of a sudden their businesses are going to go from 50% growth to 30% growth. And when you're at 100 times earnings, you've got a lot of risk and can go down. Those are the things that we're most worried about.
And you say that value's actually been outpacing growth since about September the 30th. Do you see that trend continuing, and how do interest rates play a factor?
Well, we do think that trend continues, and we think it accelerates this year. And basically, you had a guest on the other week from Ariel, which talked about the last 14 recessions, and coming out of those recessions, value outpaced growth 14 out of 14 times, and with a rising rate environment. So we think the things that are in place in the economy really come together for value starting to do better and to slow down growth. At a minimum, we think it's going to be a pretty level playing field. But right now, for new monies, we think your best bang for the buck is in these value stocks.
So you just mentioned new money. A lot of people who are retail investors have jumped into the market during the pandemic. If you were going to start a portfolio, what two sectors would you start with?
Right now, we think healthcare is very good as a place, and we think financials are really going to be one of the leaders. But we think if you're a new investor, you really can diversify. So you might want to buy like an S&P ETF and a high dividend ETF. That would really protect you, and you'll do pretty well in the upcoming year.
Shepard Smith here. Thanks for watching CNBC on YouTube.